Following the wrong kind of upside surprise on jobless claims, live from New York City this morning. Good morning, good morning. Equity futures negative 0.1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, coming up, the economic data misses are piling up. Amazon and Google struggling to fire workers in Europe. And the Trump campaign making a move for DeSantis donors. We begin with the big issue. Is bad news just bad news?
We're entering a period of higher economic volatility.
ISM manufacturing, we just had come out a couple of days ago. It's below 50 for 5 months running now.
We see the cracks appearing.
We're in a slowing economy.
Bond market's definitely telling you that this economic weakness is legit.
The question is how much is that is embedded already in stock prices, and I think that's a different story.
It's just this constant sort of trade-off.
We keep throwing bad news at the market.
Waves of bad news, reaction to bad news that's meant to deal with then more bad news.
The day of reckoning keeps getting delayed.
The Fed is not going to bail you out. The economy is not going to bail you out.
It will impact earnings. It's just a question of when.
You can't make numbers. It's going to be a very, very difficult period.
And the IMF with more bad news. This comes from the IMF, warning that the global 5-year growth outlook will be the weakest since 1990. Let's put some numbers on that. Their outlook suggesting GDP will grow 3% over 5 years versus a 5-year average of the past 20 years of 3.8%. Let's discuss some of that bad news with Apollo's Torsten Slok, Troy Gajewski of FS Investments. Gents, great to be with you. I've got to start with you, Troy. The data so far this week, ISM manufacturing services, downside surprise. JOLTS ADP on the job side of things, downside surprise. Claims, the wrong kind of upside surprise. Troy, do you think there's something to worry about here?
Without a doubt, John. I mean, this brief period of euphoria in markets where equity investors, at least from a narrative standpoint, were justifying a bear market rally because the economy was going to weaken. We had a mini banking crisis. The Fed had briefly aborted quantitative tightening, and then that was going to lead to lower rates and a great outcome for earnings and revenue is now being dispelled by the fact that, most importantly, the labor market is starting to show signs of meaningful weakness outside of tech and financial services, which is obviously a lagging indicator. And without the labor market staying this tight, it's virtually impossible to avoid a recessionary outcome at this point.
Torsten, what a year we've had together already. Our conversations have gone from soft landing, no landing to hard landing. This morning, Torsten, you wrote the credit crunch has started. It's quite an emphatic headline, Torsten. What's behind it?
So the Dallas Fed surveys 71 banks and credit unions in the Fed district. And what the data shows is that this was done from the period of 21st of March to the 29th of March, that during that period, loan volumes actually turned quite significantly down. So another way of looking at that is that we're still waiting for the senior loan officer survey from the Fed, which comes out on May the 8th. But in the meantime, this is the first piece of evidence that there's now more signs of a credit crunch that has already started because of the regional banks. Remember, as usual, the regional banks account for 40% of all loans outstanding in the banking sector. So it's not a surprise that the banking sector is beginning to pull back.
Torsten, one question I've asked through this week so far is, what are the long and variable lags of a banking shock? Are we going to find out there pretty quick, pretty short?
Absolutely. I mean, as you and I also have talked about several times, we were already in the process of going through the lagged effects of Fed hikes, and now we're adding on to that banking crisis. So another way of looking at this, also to what Troy just said, think about it. What is the Fed trying to achieve? The Fed is trying to slow down consumption. The Fed is trying to slow down hiring. The Fed is trying to slow down capex spending. So therefore, it should have real consequences. In other words, it should show up in GDP growth, in consumer spending, and ultimately in earnings.
Troy, May 3rd, Federal Reserve meets, makes a decision. Is May 3rd too soon to have conclusive evidence of everything that Torsten's talking about?
It's not too soon because there's been enough data deterioration to indicate that the probability of recession has gone up dramatically. And to Torsten's point, that risk has been pulled forward and magnified. However, we still think the Fed will more than likely hike by 25 basis points. And then from there, it's anyone's guess, right? If the Data continues to deteriorate rapidly. You keep getting negative surprises, not only in hard data, but also in the labor market. Then they'll probably pause, keep it there for 6 to 9 months. And the soonest we could see them cutting is late 23, early 24. And then the other key part of that, John, is remember that the pace of the next cutting cycle will be much more modest than what we've seen recently. It'll really be the mirror image of the 15 to 18 hiking cycle, as the Fed will need to be convinced that the trajectory of inflation is heading back to 2. And then, unfortunately, there's a reasonable probability it drops below that.
So let's build on that. Let's talk about that spread between market pricing and where the Fed is right now. Torsten, that spread was just as wide earlier this year, and that spread was reconciled with the market coming up towards the Federal Reserve. So now we've got the market pricing in the cuts all over again, and the Federal Reserve saying we're going to go to 5.1%, something like that. We're going to stay there through to year end. Do you suspect then, Torsten, based on what you anticipate, that this market is going to stay where it is and this Fed's going to have to come down to the market this time?
You're right. It was the market because of the no landing. The data just didn't slow down. We all came into this year expecting a recession, and it just didn't happen. And now we have added on to the outlook a banking crisis that is now increasing the risk of a recession. So now it is more likely what you're saying, John, namely that it will be instead the Fed coming down to the market. Another way of looking at this is that yes, the Fed is indeed looking at inflation in round numbers at around 5%, and their target is 2%. But the issue is that if you look at your Bloomberg screen and check out what ISM services paid prices have done, they have basically moved down, and they are very important leading indicators of core inflation, headline inflation, super core, also a very important leading indicator of even average hourly earnings. So we will get inflation coming down. That's also what the consensus expects. But the Fed has to stay hawkish because they need to talk to inflation expectations and make sure that they remain well anchored. And then once actual inflation starts to come down, then they begin to change their tone.
Torsten, I think a lot of people have struggled with how the conversation has shifted on programs like this so far year to date. In just 3 months, 3 narratives. We went, as you say, and we've talked about this, we went from saying soft landing to no landing to hard landing. Torsten, why won't we be somewhere else in a month from now? Who's to say we won't be talking about something totally different?
True. I have people asking me, well, why are we not going to be in a crash landing? So I still think that's really unlikely because the Fed is totally aware of all the risks that we have in front of us. But it's totally absolutely right what you're saying, that we have shifted the narrative around. That's why the MOVE index has been so elevated, that there's been all this uncertainty and continues to be elevated, all this uncertainty about what will happen to inflation, what will happen to rates, whereas VIX and equities have just remained relatively calm throughout most of this period. So it is true that this pendulum swinging back and forth about is it a soft landing, no landing, hard landing, might even be a crash landing. All that is a very important reason why markets are so volatile and why implied vol, both in rates and equities, continues to move around so much.
Jobless claims a little bit earlier this morning, upside surprise. That was about 37 minutes ago. That came in at 228. The estimate was 200K, and a big upward revision to the previous number as well. Payrolls come out tomorrow morning. Katie Lyons, payrolls have come in just a little bit. We were looking for 240. We're now looking for 235.
Yeah, that's right, which arguably relative to history is still fairly robust job growth, but that would be a slowing in the pace of non-farm payrolls additions from the month of February. So it's really going to be about whether or not tomorrow's print confirms what the data we've gotten over the last 24, 48 hours suggests, which is weakness, the lagged effect of monetary policy tightening starting to show up in the economy. Maybe you see that in this initial jobless claims print, which, as you suggested this morning, John, is the wrong kind of upside surprise, both in the weekly print and the prior revision, which, as you suggested, did move significantly upward, though part of that is due to updated seasonal factors. Then for tomorrow's jobs report, 235,000 is what we're looking for on payrolls. But the other factor that is going to be incredibly important to the Federal Reserve is average hourly earnings. We are actually expecting a tick up in the month-on-month growth to 0.3%, though year-on-year basis, we are expecting a cool down from the pace of February to just 4.3%. So the question really is, does this confirm what the market believes, which is that this Federal Reserve is going to have to start turning around and cutting by the end of this year? You see that evident in the 2-year yield once again today. 5th day in a row, this yield has come down. That is the longest stretch since July of 2022. And at 3.77%, we are more than 1% below Fed funds. So this monetary policy sensitive part of the curve suggesting that the Fed is wrong, this market betting it is right, and perhaps the data we're getting just fortifying that belief on the market's part, John.
Kelly, thanks for that. Kelly Lyons down in Washington. We'll continue that conversation with Kelly through the next 24 hours on TV and radio including tomorrow morning. Don't miss this. Just a programming note for you all. We will be with you tomorrow morning. Our coverage will start at 7 a.m. Eastern Time. It will go through until about 10 a.m. Eastern Time. We'll be catching up with Priya Misra, Ellen Zettner, Randy Krosner and Mohammed Al-Erin in the studio here in New York with us around the table. Looking forward to that, to break down that jobs number at 8:30 Eastern Time. The estimate, as I say at the moment, 235,000. The previous number, 311. Troy, do you anticipate that some of the weakness we've experienced this week will show up in that number tomorrow morning?
Yeah, you're going to continue to see that downward trend that you articulated. Remember, we still have historically a very tight labor market. The problem is the trend, right? And we see whether it's industrial production or services or CapEx, business fixed investment, housing, all of those data points continue to deteriorate, and labor lags dramatically. And so you're just starting to see this show up. And, you know, our key point has always been, look, if you look at this environment, the only thing keeping the global economy afloat has been the U.S. consumer. And a lot of the excess savings has been run down. So as soon as you see the labor market start to crack, you know, you can forecast recession coming in 3 to 6 months. And clearly the mini banking crisis that the Fed and the FDIC and the Treasury, to their credit, have done a very good job ring fencing so far, creates an additional risk factor because of credit contraction at the real economy, as opposed to money supply contraction, which principally impacts financial assets.
Troy, if the only indicator you had was the S&P 500 over the last several months, perhaps you wouldn't even notice that some of these things were happening. We've just been in this range of 3,800 to 4,200 on the S&P. Yep. Troy, based on what you've told us in the last 10 minutes or so, if we were to break that range, are you expecting that break to the downside or to the upside?
Oh, yeah, for sure. I mean, we've had a very strong bear market rally, you know, driven principally by lower interest rates and a kind of somewhat bizarre expectation that a aggressive Fed pivot was good for the economy and for earnings. Now we think 32 to 3,400 is a rational bear market low. We think multiples more than likely did bottom out. Multiples always bottom out prior to earnings bottom out. But if you look forward and just put a 16 to 17 multiple on 200 trough earnings, that gets you right to that 32 to 3,400 range, which basically is a 29 to 34% peak to trough bear market. Not nearly as severe as 2008, not nearly as severe as 2002, but meaningfully worse than 2018 and the various shocks we had in the post-GFC period.
Is it fair to say you're not a fan of the tech trade that's performed so well year to date?
Not at all. You know, I mean, look, the 17 to 21 playbook for investors was be long duration assets, be long growth. Those companies obviously did a tremendous job compounding free cash flow and earnings. You know, the problem now is so much of that upside recently was driven off exceptional lows that were created last year when the NASDAQ was down over 30%. And the idea was, hey, here we go. Rates are low again. It's time to roll out the go-go growth playbook or the growth playbook. And the folks forget that the number one determinant of any equity outcome is beta. And so if the S&P is going to drop 15 to 23% from here, it's very unlikely that the NASDAQ drops by less than 15 to 20, and in fact will more than likely drop in line with the S&P or perhaps even worse.
Well, the NASDAQ year to date at the moment up about 15%. Troy's going to stick with us. Torsten Slock as well. We'll continue to break down the economy and include a bit of China into this conversation as well. Let's get you some movers. We can do that with Abby. Morning, Abby.
Morning, John. Well, let's start out with the shares of Costco, which are falling sharply at session lows, pre-market session lows, I should say, down about 3%. This, of course, after same-store sales for the month of March came in up just 0.9%, excluding gasoline, another down month, the lowest amount of growth since April of 2020, really putting into question what's going on with the consumer, the strength of the consumer. Alibaba had been up more than 1% on a report of a ChatGPT-like tool launch plan that it's planning, but it seems that the mood of the morning is really weighing on those shares of Alibaba. And then finally, Alphabet up 0.6%, also off of its highs, as Google CEO Sundar Pichai has said that the search, the Google search, is to feature an AI-like feature. John.
Abby, thank you. Coming up on this program, Trump making a move on DeSantis donors.
As soon as he starts saying he's going to get indicted and he commands the headlines on a near daily basis, you see DeSantis slipping. It gives Trump a nearly daily platform for fundraising and for grabbing all the attention, which has been the key oxygen that supported his political career for years.
That conversation up next.
The challenge for every other Republican that they're facing is that Donald Trump continues to suck up all the oxygen in the room. And it's absolutely impossible to get traction against this guy. And we've seen this over the last couple of months. When he made his announcement in November, he was basically ignored, which created an opening for Ron DeSantis to start climbing in the polls. But as soon as he starts saying he's going to get indicted and he commands the headlines on a near daily basis, you see DeSantis slipping.
Last week, Donald Trump was the first former president to be indicted. Now, he's using the attention to make a play for the competition's backers. Donors supporting Florida Governor Ron DeSantis are getting the pitch from the Trump campaign to jump ship. A three-page memo seen by Bloomberg looks to highlight Trump's rising poll numbers and DeSantis trailing behind. Politico reporting the campaign has already raised something to the tune of $12 million since the indictment. AMH joins us now from Washington. Anne-Marie, I think it was the New York Times that said the former president has a new running mate, and it's this court case.
Yeah, that's right. Potentially District Attorney Alvin Bragg. He's using this in this memo, Jonathan, this arraignment and these 34 felony charges as a way to try to bring in these campaign dollars. We've seen it work when it comes to these emails being sent out to everyone who subscribes to the Trump campaign. And as you said, this is millions of dollars in the double digits since we got the news of this indictment. But now it looks like in this three-page memo seen by a colleague here at Bloomberg that what the campaign is trying to do is go after some big money donors. Remember, a lot of these individuals, like the Koch brothers, Charles Koch, the network he started with his late brother David, Schwartzman, all of these individuals, Ken Griffin, Jeff Yass, these people have already signaled that they want to move on from Trump world, and they are squarely going to be backing Governor DeSantis. And a few weeks ago, we saw Governor DeSantis bring a lot of them in at a retreat in Palm Beach at the Four Seasons. So this really says to me that former President Donald Trump clearly views Governor DeSantis as his #1 running mate to try to get the 2024 bid from the Republicans.
As we've talked about this, Anne-Marie, this has taken all the oxygen out of the room down in Washington, D.C. We're not talking about some really important issues, including the relationship between this country and China. You caught up with Speaker McCarthy just yesterday. This is what he had to say.
What China needs to understand is they can't dictate who a Speaker of the House can meet with, maybe with foe or friend. For the same moment that Macron's sitting down with President Xi, I think that's great. I would sit down with President Xi.
Anne-Marie, fantastic work just yesterday. What was the big takeaway for you?
Well, I don't think he's going to Beijing anytime soon. And also, he's not going to Taipei anytime soon. One thing that really struck out to me, Jonathan, is that this was a muted meeting. Remember when Speaker Pelosi went last summer? Kevin McCarthy said if he was going to Speaker, he'd want to go. But to really take the tone down, given the consequences that trip was last summer, it was done in Southern California. We saw some consequences coming up from Beijing, but not on the same level.
AMH, awesome to catch up. Anne-Marie down in Washington, D.C. Torsten Slok, I wanted to come to you on China. Not the politics, let's park that. Let's talk about the economy. You're sitting there now talking about a credit crunch. You see evidence for it in America right now. You've got a call potentially for a hard landing. What happened to Chinese growth bailing out the global economy, Torsten? Where's that now?
Yeah, so at least the outlook for now is still relatively stable for the rest of the world, including China. So, but obviously, if the U.S. does have a hard landing, then China and all exporting countries will be harder hit because they simply depend still on the U.S. consumer to a very significant degree.
Can the U.S. economy decouple in the way that some people think, Torsten?
Well, it depends a lot on the nature of the shock. I mean, obviously, when the shock a few years ago was a pandemic, obviously everyone was hit. And before that, in 2008, of course, the shock was also quite global. Now the shock really is originating in an inflation problem that has been particularly pronounced in the U.S. And now adding onto that a shock from the regional banks in the U.S., it does make it a very U.S.-specific issue that we are facing. But as usual, when the U.S. has a cold, the rest of the world does sneeze. In other words, we will have quite some significant consequences for the rest of the world, including Europe, if we do have a harder landing in the U.S.
Well, Troy, you've heard what people think about this when it comes to the market. Transatlantic rate differentials, they're expecting them to develop in a different way this time. The Fed will have to pause. The ECB can keep on going. Off the back of that comes the FX call for a weaker dollar. Troy, do you think some of that maybe is a little bit misleading?
Yeah, and when we look at this in our tactical asset allocation franchise or a multi-strategy fund, we just keep coming back to, look, you've had some degree of outperformance in Europe so far this year. However, when the U.S. has a recession, what will typically happen then is the dollar will strengthen substantially. Obviously the channels of trade will break down quite significantly, and that will revert us back to at least shorter term U.S. outperformance in a more significant sell-off. So, I think in general, again, this environment, you want to protect capital. You want to focus on free cash flow and cash flows that are resilient. You don't want to be a hero. You want to focus on that Northwest Quadrant, the efficient frontier, and find relative value opportunities like selling extremely expensive European interest rate vol and being long very expensive U.S. rate vol or yield curve steepeners that aren't speculating on dramatic direction, but have very good asymmetry to the most likely market path forward.
Torsten, I've got about 20 seconds, so let's make this a yes or no. Was the March rate hike from this Fed the last hike?
Yes.
Torsten Slok, Troy Gayeski, to the two of you, thank you. There's a call. I think a lot of people share that view based on market pricing. Looking at futures right now, we're down about 1/3% on the S&P 500. Coming up, the morning calls, and later, the case for energy. Why Cameron Dawson of New Edge Wealth is sticking to her overweight call. That conversation around the opening bell. Your opening bell, 7 minutes away. 5 minutes away from the opening bell, pulling back just a touch, not too much. We're down about 1/3% on the S&P 500. 2-day slide coming into today. On the Nasdaq, a 3-day slide coming into Thursday. Equity futures on the Nasdaq 100 down about 0.6%. That's the price action. Here's some morning calls for you. First up, JP Morgan downgrading Mosaic to neutral, $46 price target. Forecasting a challenging year as lower commodity prices weigh on upcoming results. That stock is down a little more than 3%. Your second call from Raymond James upgrading Wells Fargo to a strong buy, expecting the company to benefit from the SVB fallout. That stock is positive by about 0.8%. And your third and final call from the team at Oppenheimer, cutting its Amazon price target down to 125, saying more layoffs are necessary for e-commerce to become meaningfully profitable. That stock down about 0.7%. We'll talk about Amazon and Google trying to make some of those layoffs over in Europe a little bit later this morning. Coming up next, the Nasdaq facing a 4th day of declines. New Edge Wealth's Cameron Dawson says the pain trade in big tech is still higher. That conversation just around the corner. Your opening bell up next. Two-day slide on the S&P. Will it become 3? About 20 seconds away from the opening bell. Futures lower by 0.2% on the S&P 500. 3-day slide already on the Nasdaq. Down again on the Nasdaq 100. Will that become 4? We're down about 0.5% on the Nasdaq. Equities softer through the week off the back of weaker than expected economic data. That's the opening bell. Switch up the board and get to the bond market. Yield shaping up as follows. Lower again on a 10-year. A break of 330. 329.39. On a 10-year yield. We're down a single basis point, maybe even round it down to down 2 basis points on a session so far. In the bond market at the front end, we give up some of the move from earlier this morning. The 2-year now basically unchanged at 378. Yesterday had a little look at the 360s. Euro dollar having a little look at 108 right now. A break of 109. We're down about 1/10%. Weaker euro, 108.93. And crude, let's call it unchanged. We're down about 1/10% there. $80. We hold on to 80 on WTI. $80 in about 50 cents. About 30 seconds into the session, your equity market taking shape. We are lower by 0.2% on the S&P. On the Nasdaq, we're down about 0.4%. One stock to watch at the open is Costco. Shares falling after posting its lowest U.S. sales growth in nearly 3 years. Abby has more. Hey, Abby.
Well, John, this is the worst fall for this stock of the year, and it has to do with that weak comp sales growth. Folks disappointed. Now, if we take a look at the quarterly version, same-store sales, we are going to see the direction of what's going on here. Back during the pandemic, when you had folks stockpiling and also looking for this big box retailers discounting, same-store sales of 17%. The last quarter just closer to 6%. For the month of March, up just 0.9%, excluding the effect of gasoline. So this is really these numbers moving in the wrong direction. It's the smallest gain since April of 2020. And the bigger point here, John, of course, is the strength of the consumer. If consumers are not flocking to a big box discounter for those discounts, where are they going? Are they just really slowing down their shopping overall? You know, it's interesting, though, because this stock has outperformed on the year the overall staple space, but we can see with today's decline, it's coming back in line. And one big question here would be, up 15% at one point earlier this year, are we going to see it even out and really perform just in line with that staple space, which is about flat on the year?
Down more than 3% right now. Abby, thanks for that. Different story for FedEx, as you know. Shares touching a 7-month high, with a number of analysts raising their price targets on the courier's new cost-cutting strategy. Ed has more. Morning, Ed.
Yeah, good morning, Jonathan. We're up 0.6% on FedEx 24 hours after the restructuring, where FedEx will merge its ground and express units. The highest level since August on the stock. It was a somewhat muted reaction, all told, by the end of Wednesday's session, up a percentage point or so off a session high of 4%. But we do see a number of analysts raising price targets. They're basically calling out that simplicity is key. They feel that this integration of the two units and simplification of the business structure will take time. But if you think about what Morgan Stanley is saying, for example, through Ravi Shankar, it puts the company on a path to what he calls the holy grail of integration gains. It's a more simple entity, according to Jefferies. At the end of the day, I guess, John, that when one way of looking at cost cutting is to tighten the belt, the other is just to go back to basics with your business. And the street's certainly cheering up. We're now up 0.8%.
Some cost cutting is easier than other cost cutting. Ed, we're going to talk about some of the difficulties Amazon and Google are having a little bit later in the programme. Ed, stay close. I want to build on this story from FedEx. Plenty of upgrades. Raymond James had this to say, upgrading shares to outperform and writing, quote, integrating its primary express and ground offering, focusing on attacking costs and enhanced capital allocation scrutiny, all set the stage to drive improved shareholder returns. Were management to be even remotely successful, then we'd see material earnings and free cash flow upside in the coming years. That stock's up again by 0.9%. Let's get back to the earnings. Shares of Constellation Brands topping profit estimates and boosting its quarterly dividend by 11%. Isabel Lee has more. Hey, Isabel.
Hi, John. It was a mixed bag for Constellation Brands, the producers of beer, wine, and spirits, the likes of Corona and Modelo. Shares of the company fell after the company reported revenue falling short of estimates. The company posted a net profit of $223 million, which is down around 44% last year. Sales also fell to 5% to $2 billion, which is slightly below forecast. But adjusted EPS came to $1.98, which is beating estimates. Here's a breakdown. Beer sales fell 2% after beer price hikes last year slowed consumer demand. Wine and spirit sales also falling 9%. Those categories also saw a big expansion in operating margins. Some silver lining, the company is now expecting adjusted EPS that's higher than estimate and raised its dividend to 89 cents from 80 cents per share. The stock overall has fallen around 5% in the past 12 months, so we'll see.
Isabel, thanks for that. The latest on Constellation Brands. Looking ahead to next week, it's going to be about the earnings from the big banks. The dates as follows. On the 13th, First Republic, which is a name a lot of you have been following over the last few weeks. JP Morgan on the 14th, so that's Thursday and Friday. Perhaps Western Alliance in the last couple of days has shown us how not to do it. They provided us with a little bit more clarity around their deposit base just yesterday. That stock is now up by 2%. Kaylee has more out of DC. Morning, Kaylee.
Well, good morning, John. It took them a hot second to actually provide that clarity on deposits because first on Tuesday, they put out a statement updating their financial status, no deposit info included, and then midday yesterday finally put out that information, which helped the stock come off of the 19% drop it had at one point yesterday. We are seeing a bit of a recovery this morning with the stock up roughly 2% at the open here. But that deposit figure came in less bad maybe than anticipated. Yes, deposits were down 11% from the end of the fourth quarter to the end of the first quarter of this year, came in at $47.6 billion at the end of March. But perhaps some good news coming in the fact that a larger share of those are insured, about 68%. And the bank says that the situation has stabilized as of March 20th, and they actually had $1.2 billion in deposit inflows in the first 4 days of this month. So the question really is now, is the worst over, not just for Western Alliance, but regional banks largely who have been struggling with deposit outflows as there remains a lack of clarity around policy, around insurance, and of course, we have signs stacking up of a weakening economy. So all of that is in focus for these stocks that have been brutally punished this year. Western Alliance has lost half of its value year to date. First Republic down 89%. Regionals as a whole down nearly 30% over the span of just a couple of months, John. So the question is going to be now, as we look at these earnings reports, what they say about those deposits and, frankly, just their health overall, John.
Looking forward to those earnings coming out next week. Katie, great coverage as always. Katie Lyons there down in D.C. I keep returning to the calendar. What a week we've got lined up. Tomorrow morning, payrolls. On to next Wednesday on the 12th, CPI. The 13th, First Republic. The 14th, JP Morgan. And a ton of bank earnings in between. This is where we stand right now. Equities down about 0.4 on the S&P. More weakness in the Nasdaq again. The composite there down about 0.75% on the Nasdaq. Even with this is your backdrop in the bond market, yields lower again on a 2-year by 2 basis points to 3.76. Cameron Dawson and New Edge Wealth looking ahead to earnings and writing the following. Yields dropping in the face of weak PMIs suggest that there is more earnings risk on the horizon, but that has not been reflected in estimates just yet. Cameron, I'm pleased to say, joins us now. Now, Cameron, you've put it in the way that I've been asking. Is bad news just bad news?
Well, if you base it on the last 3 days, it certainly seems that way. It means that equities are starting to wake up to the fact that usually when you see pricing for a lot of Fed rate cuts and lower yields and a re-steepening of the yield curve after an inversion, it means that there actually is economic and earnings risk on the horizon. And what we've seen within markets is really just thinking on that easier policy will help valuations. But if you look at the earnings front, you're still pricing in flat earnings growth on a year-over-year basis in 2023, and then a 9% jump in 2024. If we have a recession at any of those points, those numbers are still too high, meaning that you have to revise them lower and that the valuations look even more stretched where we sit today.
Cameron, can you take any comfort from how the bond market's responded to the incoming data this week?
No, because the bond market is responding with continuously lower yields, and we're about to break some pretty important support for yields, which would suggest that the pricing in of those Fed rate cuts in the back half of this year, that the bond market is getting even more confident that those will actually materialize. But we are questioning if the Fed will deliver on those rate cuts. They continue to say that they see no urgency in order to cut rates. They're afraid of inflation coming back. So we have this widening chasm between what the bond market is thinking the Fed will do and what the Fed is saying it will do. So it certainly points to continued volatility, not just for equities, but also for bonds.
Now, equities right now on the screen, the Nasdaq's down about 0.8%. Cameron, this is even with another rally in the bond market with yields just a little bit lower this morning by a couple of basis points or so. Can you draw some conclusions about where you think this relationship between bonds and equities is going?
Well, within tech stocks and within growth stocks, we do think that they move too far too fast in getting to a huge valuation premium to the broader market. The fact that they traded to a nearly 40% premium for the tech sector just back last week would suggest that they were already pricing in a big, huge rate cut path and a much easier Fed already into the price where they were today. And they were ignoring the fact that just because they're tech or just because they're growth doesn't mean that they have complete earnings resilience. That if we do actually have a weaker economy, do actually have an earnings recession, they will experience weaker earnings, which just then again puts their valuations to be even more extended as you see those earnings revised lower.
So Cameron, let's say the bond market's right. The disinflationary bust arrives. Given what you've just said, where would you expect equity market leadership to come from in that world?
Well, it likely would shift again further away from the cyclicals into the defensives. And that has been something we've been seeing over the past couple of weeks. Cyclicals have really started to break down after they led the market higher from the October low, as we started seeing that no landing data, much better growth data to begin the year. And you did see cyclicals leading. But over the past couple of days, you've had some pretty big downside volatility in things like industrials and materials and even the semiconductor semiconductors would suggest that there is more growth risk on the horizon, and would suggest that as you look into more earnings uncertainty, that you want to lean more into defensives. So your classic defensives like healthcare, utilities, and staples, which have really lagged to start this year.
Cameron, a couple of years ago when someone said defensive, it wasn't just healthcare, utilities and staples, it was also tech. You touched on it briefly there. Do you think people still underestimate just how cyclical some of these names might be?
I think that we have to think of tech in very specific camps, because there are parts of tech that are highly, highly cyclical. So if we think about semiconductors, of course, very sensitive to global manufacturing cycles, hardware very sensitive to IT budgets on a corporate basis, but software tending to be less cyclical. They have more recurring revenue bases. And so that does help them have much smoother earnings through the downside in the economic cycle. So there's probably portions of tech which will be much more defensive than other parts of tech. But if we look broadly, the index does actually have much better earnings performance in down cycles than you see in other cyclical industries. So back in 2020, as well as during the great financial crisis, tech did outperform on an earnings basis if you compared it to things like industrials or materials. But if we look deep underneath, it really was because of those more defensive parts of the tech sector.
Cameron, great work as always. Cameron Dawson there, who joined us a number of weeks ago and said, beware the bull steepener. The economic data starting to validate that move in the bond market, and now starting to see some weakness develop in the equity market as well. Third day of losses on the cards on the S&P 500. Day 4 on the cards on the Nasdaq. On the S&P, we're down 0.5%. On the Nasdaq, we're down 0.75%. Yields just a little bit lower at the front end by 2 basis points on a 2-year 376. Your 10-year just sub 330 at about 328. Coming up, let's talk tech. Tech workers left in limbo amid cost cuts.
There's probably more to come, whether it's in terms of business failures, bankruptcies, layoffs.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, IMF Managing Director Kristalina Georgieva. That conversation at 10 a.m. Eastern, 3 p.m. in London. This is Bloomberg.
There's probably more to come, whether it's in terms of business failures, bankruptcies, layoffs, which we're already seeing well up the wage and managerial spectrum, which is another thing that's different about this contraction, slowdown, whatever you call it, eventual recession, is the layoffs are happening more top down versus the typical start with bottom up layoffs.
Big tech layoffs are stalling in Europe. The same companies announcing job cuts here in the United States, struggling to let go of workers across the other side of the Atlantic. A Google spokesperson telling Bloomberg the following: "We've been working carefully through each country where reductions are taking place to fully adhere to local legal requirements, which are complex and take time." I said Ed should stay close. Ed's back with us now on the West Coast. Ed, are you telling me they're finding it difficult to let people go over in Europe?
Yeah, very difficult. The reality is that labour protections, particularly within the European Union, make it hard to enact layoffs where there has not been prior consultation with workforce bodies. And that's where the detail in the reporting is. According to one Bloomberg source, particularly in France and in Germany, Alphabet, the parent of Google, and Amazon are having to negotiate with work councils. These are company-specific, peer-elected groups that negotiate with management on what the size and scope and specific roles impacted by layoffs look like. Then you go to the specific jurisdictions and the specific companies. In Alphabet's case, parent company of Google, they are trying to find workarounds. So in France, according to one source, they're leaning very heavily into voluntary departures and looking at attractive severance packages that hopefully will entice workforce in that nation to leave, right, of their own volition because of the issues that are ongoing. That said, sources telling us that the resolution in that market in France for Alphabet is weeks away. And you have to remember that these are layoffs and cuts that were announced going back towards the end of last year. Another example, Amazon in France, for example, has offered senior managers a whole year's pay, 1 year's worth of pay, Jonathan, if they resign. Then you go to the complications of the technology sector. How are they going to deal with the issue of stock grants and other compensation? Well, they're basically granting long-term leave to those employees that they're pushing to depart in order to allow them for their stock to vest and their bonuses to be paid out. So you can see the complication that's going on here. And as you point out, Google issued us that statement also acknowledging that in some markets, Romania, Greece, Austria, they're not going to try and do layoffs. Amazon declined to comment on the story.
Ed, can you give us some more clarity? Is this going to change their thoughts, the decision they made about cutting people off, or will it just make it more expensive to do so?
The cost of it, is quantified, in both Alphabet and Amazon's case, right? They put dollar figures on it in the sort of low billions of dollars. One thing that sources were telling me in Alphabet, the parent company of Google's case, is that there were layoffs that were made or announced, and very quickly managers realized that there were people on those lists that they really still needed. That's an example that we heard about in Twitter, for example, which is a very different ballgame, but where there were people that were cut that were then asked to come back. I think the breadth of these layoffs has made it very complicated for big tech companies because they're finding that using a scalpel takes too long. So they come with a sledgehammer. This is also something we've reported in Meta's case, but may realize that actually roles they're eliminating are quite useful for the future. So they're having to do a rethink.
Interesting.
Time is the real issue.
This is fascinating. I'm looking forward to the programme with Caroline Hyde in about 2 hours from now. I'm sure you'll pick up on this story. We've talked for years about the labour market flexibility here in the United States and the absence thereof over in Europe, and this is a perfect case study example of that taking place. Speaking of Europe, Credit Suisse, top executives facing bonus cuts. The Swiss government ordering their payouts to be cut by up to half or outright cancelled following the UBS takeover. Bloomberg's Jan-Patrick Barnett joins us now for more. Jan-Patrick, I have to say, when I saw this, I wasn't really surprised. Were you surprised?
No, not at all. I mean, bonuses were already frozen last month. And I mean, it makes total sense from a political perspective, especially if you are a politician who wants to be reelected. You simply can't pay out bonuses in the millions. And on the other hand, you grant billions of euros for protecting this merger, for loss absorbing, which I'm pretty sure UBS will make use of. It's simply not a political message that you want to have out there. Of course, it creates a whole lot of problems for the new company, UBS, Credit Suisse combined internally, because also not every manager is responsible for what happened to Credit Suisse. And if you've done a decent job in your area of responsibility, and you're now being one of those whose bonus is being cut or even outright suspended, it's probably not being good for morale. And maybe you want to look somewhere else, and that will make it harder for the new company to keep the high-performing talent on board.
Jan-Patrick, you and I talked earlier this week about what Colm Kelleher had to say, the UBS chairman, about how long this integration could take, maybe up to 4 years. When do you expect to see the headlines, the real news about the degree of job cuts we might get from that combined entity?
Well, I would expect that we see something in the next 2 weeks. I guess they will need to figure out some details here. And you just spoke about like labor rules in Europe, and they are also very strict in Switzerland. So there's a lot to figure out there. But we have the UBS earnings coming up at the end of the month, and I'm pretty sure that they want to present at least some roadmap, what they want to do for the next couple of weeks and months. And so I would expect that we see more of details and more of planning coming to light in the next couple of weeks.
April 25th is when we get that earnings release. Jan-Patrick, thank you, sir. As always, just the latest developments in the job market, both in tech and in finance, both in Europe and in the United States. Let's get you some sector price action. Equity's a bit softer this morning. Here's Abby.
It certainly is, John. We're looking at a third down day for the S&P 500, as you have mentioned, the longest losing streak in about a month. And it's a risk-off sector tone. It's very interesting because the only sectors higher today, they're basically those defensive sectors, utilities, healthcare, real estate. Real estate's not officially defensive, but it has dividends. So folks are looking for those dividends, that safety, especially as yields fall. Tech and consumer discretionary, mega cap tech down about 1%. Let's take a look at that sector over the last 4 days. Along with the banks, actually, and this is the last year. But over the last 4 days, both of these sectors lower. You can see over the last year, we certainly have tech outperforming, a lot of this having to do with the recent snafu, of course, with regional banking.
It's tech outperforming in a monster way year today. Abby, thanks for that. The Nasdaq doing tremendously well. Year today on the session, not so much. We're down about 0.7% on the Nasdaq. Call it 0.8% lower on the Nasdaq 100. We're down 0.4% on the S&P. Busy morning tomorrow morning. Payroll's just around the corner. Busy week next week as well. Your trading diary up next. on the 2-year lower for 5 straight sessions, capturing some of that weakness in the data and the equity market responding with bad news meaning bad news. We're down about 0.5% on the S&P. Jobless claims, the wrong kind of upside surprise a little bit early this morning. The Nasdaq down 0.8%, even with that move developing in the bond market. That's the price action. Here's your trading diary coming up. St. Louis Fed President Jim Bullard speaks at the top of the hour tomorrow. The main event is payrolls Friday. We'll look out for that. More Fed speak coming next week with Williams, Kashkara, Harkey and Harker and Goolsby all coming up. FOMC minutes and US CPI coming up on Wednesday. PPI and another round of jobless claims on Thursday. Look out for our special coverage tomorrow morning. It starts at about 7 a.m. Eastern time. We'll be catching up with Priya Misra, Ellen Zentner, Mohamed El-Arian and Randy Krosner. Looking forward to that. For the rest of you, enjoy the long weekend. This is Bloomberg.